Welcome back. Time to talk to Patrick Morris now. He is Senior Managing Partner at Hagen Capital here in New York City. Mr. Morris, always nice to see you. Thank you for joining us today. So I'm going to start with talking to you about the hedge fund industry and these insider trading arrests. And you are in the industry. Is this a black mark on the industry, you think?
Well, there have been several unfortunate black marks on the industry over the last couple of years. We've had performance as a black mark, sort of defying the term hedge. We have this insider trading scandal, which seems to be getting bigger, which is very unfortunate. And we've also had sort of this concept that, all the money is sort of shifted toward the top 10 or 20% of funds, that there's some security in the large funds that may or may not actually be there.
Okay, so what's the solution here? Is the solution more regulation, and is it not a concern of the hedge fund industry that really what shape this regulation will take and how much lawmakers will sort of try to come down on the industry?
Well, again, this presents an interesting problem. I think most people would like to think that they can be self-regulated, and I think time shows that when you leave sort of call it a Wild West approach, where you're going to monitor your own behavior, a lot of times people will take advantage of that lack of regulation. I do think one of the unfortunate things that could be part of the increased regulatory environment is that costs will increase for smaller, more entrepreneurial funds. It will reduce the number of startups, and by nature that should actually reduce the amount of innovation that comes into the financial services market. So that could be unfortunate.
Okay, what would work in terms of more regulation then?
Well, I mean, I think that you have to have some of the larger funds more regulated just because they have such an impact on the market and there are so many people involved in them, and hedge fund investing has become pretty mainstream. So I think that maybe north of 100 or 200 or maybe even $300 million, you have to really consider that they need to be regulated in a fashion that's more sort of similar to what the mutual fund industry has to endure. Okay,
now let's talk about the markets. What do you think is behind all this good feeling today? Is it earnings? Is it Cisco only? Is it economic data and it's a little bit of relief?
The economic data is interesting. I mean, I think it's a combination of all those things. I think we still stand on relatively shaky ground. We need to create jobs in the United States. It's a service-driven economy. People need disposable income. Banks need to lend. We need to be sure that the commercial real estate crisis that could be building isn't actually that severe. There are a lot of things that have to resolve before I'm going to be highly confident in the market going much higher from here.
Okay, and in one of your recent notes you actually wrote that you, if I could say, haven't been impressed by this rally because you said it's been a flight to low quality stocks and that's not sustainable. So are we at a tipping point now?
Well, interestingly, in this reporting period we've seen some of the larger, more name brand technology companies produce pretty good earnings. Some of the smaller tech have disappointed, but I think across the board in the market, since its low back in March or April, what you've seen is you've seen a lot of very low price stocks with not very impressive fundamentals rally very, very impressively. And that's what I mean when I say it's been a low quality rally. What we need to see is we need to see folks really focusing in on fundamentals, buying companies with improving revenue, improving margins, improving earnings, and we have to get to a point where those improvements are not from these incredibly low levels where things have been discounted down to in this decline. Okay,
now yesterday, did you think the Fed was quite dovish in their view? What did you think?
At some point, the Fed is going to have to make a decision, and the decision is going to be, do they slow down the economy a bit to avoid inflation or even hyperinflation? And it's a really, really tricky game. They find themselves in a very difficult position. You don't want to stop whatever momentum we've started to get. They don't want sort of a W-shaped pattern. They don't want us to fall off a cliff again. On the other side, you don't want to encourage consumption at a rate that's going to increase oil prices, metal prices, runaway commodity inflation, because that really hurts all of us around the globe, emerging economies and developed economies. So they're walking a very fine line. It's not a job that I would want right now.
Okay, one last quick question. Tomorrow's big employment number, we're all pretty much waiting for it now around the world because we know how important it is. Are you going to be disappointed, do you think?
I don't think I'm going to be disappointed. I think it's possible that people might be disappointed. I think you could see the number go over 10%. We accept that this is a jobless recovery. And by the way, to your last question, if the number is really impressive, it brings us closer to a rate increase than maybe people want us to be right now. So actually a great number could hurt the market a bit.
Okay, so that's where we stand for now. Thank you so much for joining us. We'll see you again soon. Thanks for your time. That's all the time we have.